There are two bodies for making decisions at a company setup. One is called board of directors. So as I told you, directors are chosen by the shareholders, and director, they act on behalf of the company. If they are within the authority of company, their acts are called intra vires. And you see, company takes the responsibility and liability for those acts. But if the acts of the directors are outside or beyond the authority of the company, then they are called ultra vires acts, and for that, the directors would personally be liable. For instance, if the company is dealing in production of sugar, it has got a production, a sugar factory, and directors have made a deal for buying rice. So that is ultra vires. Company is not authorized to deal in rice, in the sale and purchase of rice. So that would be attributed to the directors, and that would be considered as their personal, you see, act for which company will take no liability, no responsibility. So I told you that there are two bodies. One body is called board of directors, and they make decisions. And the other body is the general body of shareholders. Okay, so board of directors, they take they dispose of minor business, minor decisions. There are certain important decisions which the board of directors is not authorized to dispose of. That business has to be submitted to the shareholders. And for the purpose of, you see, presenting important businesses of the company to the shareholders, the company has got certain meetings, certain general meetings. There are three types of general meeting at a company. The very first meeting is called statutory meeting. It takes place once in the life of a company. Number two is annual general meeting. Every company must have a general meeting of its shareholders once in an year. And the third category of meeting is called extraordinary general meeting. Just suppose that if there is some urgent matter to be submitted to the general body of shareholders, a company can call an extraordinary general meeting. Let us see what is a statutory meeting. Section 130, according to Section 131, every public company having a share capital shall, within a period of 180 days from the date at which the company is entitled to commence business, or within 9 months from the date of its incorporation, whichever is earlier. Like if it was incorporated on the 1st of January and it was allowed to commence its business on the 1st of March. So here it would be seen it has to be convened within 180 days from the date or at which the company is entitled to come within that date. If it is, you see, it was allowed to start its business, it secured its minimum subscription, as I told you, on the 1st of March. So from the 1st of March, within 180 days, it has to be convened. Or if it was you see registered on the 1st of January, so it will be compared which period is shorter and which is earlier, and that date the statutory meeting would be called. In statutory meeting, what happens? You see, all the important matters are decided. Like at the top of the agenda is the appointment of first directors. You see, as you saw that the first directors are appointed by the memorandum of association, and as I told you that the promoters, the persons who conceive the idea of having a company and who get the company registered, they become the first directors, and they hold their office of directorship till the time the first, you see, general meeting, which is called statutory meeting of the company, you see, is called. In that meeting, first directors are chosen, and for the purpose of choosing first directors, you see, a poll is conducted. And I have already told you that every share in a company carries one vote. If you have 50 shares, it means that you have 50 votes. You can use it for one person to elect him as a director. You can split it among two, three persons, whatever the case may be. So in the first general meeting, you see, which is statutory meeting under section 131, you see all the important matters are submitted to the shareholder, to the general body of shareholders, and their approval is sought for that. A report is submitted in the first statutory meeting, which is called statutory report. This statutory report, you see, contains all the important matters about the company's business. Okay, what is the financial? Who is the auditor? Who are going to be director? What are the qualifications of director? All these details are included in statutory report. Second type of meeting is the annual general meeting. You see under section 132 of the Act, every company shall hold an annual general meeting within 16 months from the date of its incorporation, and thereafter once in every calendar year. Once in every calendar year. What does, when the calendar year starts, you see, as you know, that a financial year starts from the month of July. You see, an academic year starts from the month of September. A calendar year starts from the month of January. So every company must have, you see, and this meeting once a year, you see, within the time from January, from 1st January to 31st December. It means that if a general meeting is called on the 30th or 31st of the December, that would be within the period. The first general meeting, you see, the time for calling a general meeting of the shareholder is 12 months. But for the first meeting, the very first annual general meeting, the time which is prescribed by section 132 is 16 months. Shall hold an annual general meeting within 16 months from the date of its incorporation. Meaning if the company was incorporated on the 1st January of 2020, you see, it means that it has to call a meeting before the 30th of April of 2021. If this meeting is not called, then you see it can be wound up. Okay, that's another procedure, but it has to convene, it has to call, a company has to call its first general meeting within 16 months of its incorporation, and afterward every year within a calendar year once, either in March, from any time from January to December, it can call an annual general meeting. And the purpose of annual general meeting is to you see, submit certain matters to the general body of shareholders and to seek their permission, you see, and if needed, a poll is conducted, meaning that all the decisions in the company's business are made democratically. If you see, and for that purpose, I have told you that decisions are called resolutions. There are certain matters which can be decided by simple majority. Just suppose that if there is a matter upon which the board of director or managing director is seeking the, you see, approval of the general body of shareholders, if 51% shareholders are on one side and 49 are on other side, the decision would prevail. Okay, and that would be called a resolution, a decision passed by 51%
Anh bata boleh.
of votes would be called an ordinary resolution. And there are certain matters which cannot be decided by the general body of shareholders by simple majority. You see alteration in the memorandum of association or article of association, like increase of share capital, or you see decrease in the amount of share capital. These are the decisions which must be supported by three-fourth majority. So a decision which is supported by three-fourth of majority of the shareholders, you see, that is called a special resolution. Okay, so all these businesses are done in the general meeting, like how much the company has earned during the last year, and what would be the share of what would be the share of every shareholder, that is called dividend, how much dividend every share is going to have in the profit of the company. All these decisions are made. If directors are getting retired, new director, appointment of new directors, they are you see elected in the annual general meeting. Sometimes what happens that you see certain urgent matter is are faced by the company administration, and they are so urgent that they cannot be postponed till the time of uh, annual general meeting. For that purpose, under section 133, company is authorized to call a meeting in urgency, you see, to decide certain urgent matters. That is called extraordinary general meeting. Section all you see, section 133 says that all general meetings other than the statutory meeting and the annual general meeting of a company are considered as extraordinary general meeting. Any meeting which is neither, you see, statutory meeting which take place once in the life of a company, or annual general meeting which is called once a year, you see, any other meeting besides these two meetings are called extraordinary meeting, and there is no restriction upon the number of extraordinary general meeting which can a company may call more than one extraordinary general meeting. It depends upon the matters. It depends upon the urgency of the matters. Okay, so this is uh, about the meetings. Then coming to the last topic in company law, and that is winding up of a company. While defining company, you see, and talking about its salient features, we said, you see, that a company has a perpetual life. Why? Because it is distinct personality from, unlike partnership, a partnership or a firm is not a distinct personality from its members, from the shareholders. While a company is a distinct personality from its shareholders, and it has a perpetual life. How it is? It has a perpetual life. Why? Because you see, if you look at the setup of a partnership business, you see, partnership dies with the death of its partners. Okay, a firm dies with the death of partners. Either, even if a single partner dies, you see, a company may die with the death of that single partner. But as against this, you see, in a company setup, if all the shareholders die, company is not going to die. Why? Because it is distinct personality from the shareholders. At the most, what can happen that the shares which the deceased shareholder owned, that would be inherited by their legal heirs, and the legal heirs of the shareholders will step into their shoes, and they will become the members of the company. That's why the company is not going to die. Anyways, it never means that the company once created it cannot be put to an end, cannot be put to death. It can be put to an end, and there is a special procedure for that. And that procedure, I mean, that process is called dissolution of a company. But before the dissolution of the company, you see, its accounts have to be settled. You see, if it is indebted to someone, you see, the creditors would be paid. If it has got some properties, that properties would be sold, and you see, creditors would be paid out of the proceeds of the sale. And if you see there is something surplus, then the shareholders would be paid out of that surplus. This process, the settlements of account, you see, for dissolution of a company's business is called winding up. Okay, so in winding up, there are three types of two types of winding up. Okay, three types of winding up. Winding up, by sometime a company is wound up or dissolved by a court of law in certain circumstances. Sometimes it is dissolved, it is wound up voluntarily by the shareholders. The shareholders, they decide that now they should bring the life of the company to an end, and they should separate from each other, whether the company is a public company or it is a private company. Under section 302, if you look at 302, it has got a long list of circumstances in which a company can be wound up by the court. But here question arises that how would the court take, you see, the matter into its consideration? Either suo moto? No, it's not possible. There are thousands of companies. So court cannot take the matter suo moto. Someone must take the matter to a court of law. You see, and if the court of law is convinced that yes, there is a valid ground that the company's business should be wound up. Years ago, Taj Company's financial condition was very bad and it was not able to pay off its creditors, so the matter was taken to the court of law, Lahore High Court. But Lahore High Court didn't agree to wind up the business of Taj Company Limited, and it said that the company should uh, still carry on its business of publishing Quran. You see, and it worked under the supervision of Lahore High Court for a couple of years, and then it earned a lot of money and it paid off its creditors, and it wasn't wound up, it wasn't dissolved, and still it is working. This is a public company. Okay, so section 302 talks about the, I would hurriedly read, you see, the circumstances in which a company can be wound up, you see, uh, by the court of law. Like number one case is if the company has by special resolution resolved that the company be wound up by the court. Okay. If the shareholders, the majority of shareholders, huge majority of shareholders, uh, three-fourth majority of shareholders have decided that they should bring the company to an end. They can do it themselves as well, but if they prefer to take the matter to a court of law, they can, you see, any one of the parties or the shareholders or creditors can take the matter to a court of law, telling the court that there is a resolution which is passed, which is a special resolution, which is passed by three-fourths of majority. So this is the first case in which a court will wind up the company. And winding up, how the winding up would take place? When winding up is by the court will appoint an official assignee. An officer of the court would be appointed, and all the assets would be given into the charge of official assignee, and his job would be to sell the assets and to pay off the creditors of the company and eventually report to the court that everything is okay. Then the company would be dissolved. Number two case in which a company can compulsorily be dissolved by the court of law is if the default is made in delivering the statutory report to the registrar and holding the statutory meeting. Statutory meeting is a must. It shall be called by, and a statutory report must be prepared. I have talked about it, you see, in outline. And this statutory report has to be filed with the registrar of the company. If default is made in delivering the statutory report to the registrar or in holding of the statutory meeting, in both the cases, either the statutory meeting is not held or the statutory report is not filed with the registrar, you see, court can dissolve, court can order the winding up of the company and dissolve the company. The next case is if default is made in holding any two consecutive annual general meeting. Just now I told you that every company shall have one annual general meeting of its shareholders once in a calendar year. Okay, if two consecutive meetings are not called, like you see in 2019, no meeting was called by the company in 2020 as well. So these are two consecutive years. Then the company can be wound up and dissolved by a court of law. If just suppose that a meeting was not called in the year 2019 and 2021, they are, since they are not consecutive years, that's why that cannot be you see, a ground for winding up of the company by the court. The next is if the company has made a default in filing with the registrar its financial statements or annual returns for immediately proceeding to consecutive financial years. One of the essential requirement is that every company has to file with the registrar its financial statements and annual returns. So if for two consecutive years these documents are not filed with the registrar, it can be a good ground for winding up by the court. If the next is if the numbers of the members is reduced in the case of a public company below three and in the case of a private company below two. You know it very well that the minimum number for a public company, the minimum number of members, that is to say shareholders, is three. Okay, so if it goes below three, and in the case of a private company, if it goes below two, then it can be wound up by the court of law. If the company is unable to pay its debts, if just suppose the company's financial condition is that bad that it cannot pay off its the claims against it. Okay, uh, so is the case with the uh, if the company is involved in unlawful activities, fraudulent activities, if it is proved that the company is involved, it can be proved, you see, in the court that a company is involved in a fraudulent activities, or it is carrying on a business which is forbidden by law. Just suppose it is forbidden. Just suppose when at the time the business was started by the company, the object of the company or the business of the company was a lawful business, but later on, just suppose that a law was promulgated because of which the company's business, you see, or the trade in which the company is involved was declared as unlawful. So in that case, too, the company would be dissolved. Same is the case with the company which is run and managed by the person who failed to maintain proper and true accounts. If it is proved that the directors or the auditors or accountants, they are not preparing the true accounts, you see, then that is also a ground for its winding up by the court. Or if it is managed by person who refused to act according to the requirement of the memorandum, or if it is managed by the people, by the directors who are not running its business, who are not carrying on its business according to the requirement of memorandum of association, it can be wound up by the court. If being a listed company ceased to be such company, if a company is a listed company, a listed company is that company whose shares are listed with the stock exchange, okay. And there are certain requirements. If those requirements are fulfilled, then the company can place its share on the stock exchange. You know that stock exchange is a market of buying and selling shares. So a company which is allowed to trade in with its shares in the stock exchange is called listed company. And is, I mean, for being a listed company, it has to fulfill certain requirements. If those requirements are not fulfilled and a listed company ceases to be a listed company, it can be wound up by a court of law. In the same way, if a company ceases to have a member, if a company ceases to have a member, how can it be possible that the company ceases when all the shareholders have sold their shares to the company and have taken their money and have gone, and there is no member at all? In that case too, company can be wound up by a court of law. And you see, the next ground for winding up of the company under by the court is if the sole business of the company is the license. If a license is given to the company for a business and that license has been cancelled by the licensing authority, that also can be a ground for its winding up by the court. Uh, and you see, the last ground for winding up of a company by the court of law is if a listed company suspends its business for a whole year. You see, if the business of the company is suspended for 1 year, for one whole year of 365 days, it can be a ground for taking the matter to a court of law and to get the company wound up by the court. But the condition is that it is listed company. If it is not listed company and it suspends its business for 1 year, it can't be a ground for its winding up by the court. Okay. Then comes voluntary winding up. You see, the shareholders, they themselves can wound up. If they don't need the intervention of the court, they can decide, and they can decide it naturally by a special resolution. You see, if the company passes a special resolution that the company be wound up by voluntarily. If there is a difference of opinion, you see, among the shareholders, few shareholders are saying that it shall be wound up. The other fraction of the shareholders, they say that no, it shall carry on the business. So naturally, a poll would be conducted by the management of the company, and if the decision of winding up, you see, is supported by three-fourth majority of the shareholders, it would be wound up, and this winding up would be called voluntary winding up. All right. So section 347 says that a company may be voluntarily wound up in the following circumstances. Number one, if the company is in general meeting passes a resolution requiring the company to be wound up voluntarily as a result of the expiry of the period for its duration, if any, fixed by its article, or on the occurrence of any event in respect of which the articles provide that the company should be dissolved. If the company, you see, has been incorporated for a fixed period of time, you see, then on the expiry of that time, the shareholders can pass a resolution, a special resolution. If no duration has been fixed, and simply the shareholders, you see, under the same sections 347, they make a resolution that it's enough. Enough is enough. Now we should stop this business. We should bring this company to an end. They can do so. All right.